tell us more about Hindalco, here's my colleague Ashisha joining in live. Good morning, Ashisha.
Hi, good morning. So Hindalco yesterday at its analyst or rather investor meet came out with an ambitious $8 billion CAPEX target, where for its India business it has increased CAPEX from $1.1 billion US dollars to $2.4 billion US dollars, and Novelis, which is Hindalco's wholly owned subsidiary, for that as well they've increased their CAPEX from $1 billion US dollars to 4.5 to 4.8 billion US dollars. With this, Novelis will be increasing its rolling capacity to 5.8 million tons to previously targeted 4.5 million tons. Additionally, management has also said that they will be parting with 8 to 10% of their cash flows as dividend. CLSA on account of this has come out with a note where they have downgraded to outperform from the current buy rating. They have given a target price of 695 rupees per share. They say that the organic capacity expansion in Novelis is happening after more than a decade, and upstream expansion hinges on renewable power availability. They have downgraded to outperform post the rally, especially because the stock has already run up quite a bit in the last couple of months. Additionally, JP Morgan has also come out with a report where they have downgraded the long-standing overweight to neutral rating, while they say that while the balance sheet has materially improved over the last couple of months and years, earnings leverage to higher LME remains, and they believe that the risk reward is not attractive at the moment. Europe and US could negatively be impacted if LME prices sustain above the $3,500 per ton.
Okay, that's the brokerage views that have been coming in as far as Hindalco goes. Kunal, I'm going to come to you for Max Healthcare. There is a big block deal that is expected where KKR will be downing its stake, base size about 2,800 crore rupee. That's the buzz. The entire healthcare space has been buzzing. According to the data that's come out, the FIs, when they started to make their comeback, they've been gravitating towards healthcare.
And I think for Max Healthcare specifically, it could be an interesting turn of event. And remember, I think tracking the stock when it was at 350, 360 levels, just about I think mid of 2021. And from there, I think in a matter of, 2 or 3 months, stock had climbed up to even 445, 450 levels for itself. So, the last or the second half of 2021 was quite fruitful for Max Healthcare. But somehow in the last 2-3 months, like many of these mid-cap names, even this stock had managed to correct from 450 to, I think, 325 or 330 levels the stock had seen. So I think now this could be possibly a turn of event for even Max Healthcare if the stock manages to just about hold up to its previous supports. That's, I think, around that 325, 330 mark. That could be a sign that the stock could be ready for breakout yet again above those 400, 450 mark as well. So the setup on the more medium to long term basis is quite attractive for Max, but it's just that the volumes as well as the price action was getting into more subdued kind of a price action rather than any major pickup of price trends like what we've seen in 2021. So hopefully this could be possibly a turn of events for Max Healthcare. And if this happens, we could be looking at the stock inching back towards its previous size of 450 plus as well.
Okay, that's the word coming in on Max Healthcare. Getting a move on then. Kunal, let's get in a word then on some of the stocks that really contributed to the rally yesterday. While you did have financials at the forefront, there were names like Tata Consumer, Power Grid, something like M&M and Nestle as well that stood out, not to mention Reliance Industries, up nearly 2%. What is the trajectory for RIL on the charts, and Tata Consumer being one of the key newsmakers just yesterday? Where do you see these two candidates headed?
Yeah, I'll start off with Tata Consumers because that's an interesting chart. The stock had spent more than 3.5 to 4 months below its 200-day moving average. Now, there are two types of corrections which we ideally look out for. Whether the stock completes a price-wise correction, by that I mean it retraces almost 20-25%. You look at the highs for Tata Consumers with respect to the lows. I think 885 approximately was the major highs for Tata Consumers, and the stock had come back towards 675, 680 levels, which means a correction of almost 24%, 25% gets completed for Tata Consumers in the span of the last 6 months. Then you look at the time-wise correction. The stock has spent more than 3.5 months. I think from December lows when the stock had broken its 200-day moving average, it spent almost 3.5 months below its 200-day moving average. So both those time and price-wise corrections have completed for Tata Consumers. Now it's a matter of time that how the stock can gain its momentum back again and come back to its previous highs. So I believe that the risk reward, the correction nature of the stock seems to have completed, and now there could be a very strong signal that the stock may resume its uptrend. In fact, on a day like yesterday as well, the stock managed to touch and go above its 200-day moving average, even though it didn't close above its 200-day moving average. But I believe over the next few days or maybe over the next couple of weeks, the stock should try and do that. So that could be a strong turn-off event, which is why Tata Consumers is a very attractive buy at current zone. Reliance, we've discussed this time and again that how strong the stock has been in the last 1 week, 10 days. We've discussed this when the stock was breaking out of the 2400, 2450 mark for itself. I'd mentioned that the stock tends to have a very high correlation with respect to the Nifty, of course, with the high weightage as well, which the stock enjoys. So I think in that sense, Reliance should continue to march up higher, and it's more of a very stable, steady buying which you're seeing for Reliance Industries, which I think should take the stock back towards its previous high. 2780, 2785 is the previous high, which should be another 100 to 125 points for Reliance Industries.
Okay, that's the view coming in on Tata Consumer and RIL. But let's also hear it from Neeraj Diwan, Director of Quantum Securities, who spoke to ET Now about marine exports and how they can see a pickup in pace as margins have improved. Listen in.
Today I picked Isb Agro. This is a company from West Bengal. It is into spirit and liquor business and marine products business. The spirit and liquor business, they manufacture ENA and IMIL. So they are one of the largest from West Bengal for IMIL. And then, this business, when you take one by one, the first business, the distillery business, they have been growing. So they recently expanded capacity from 110 KL per day to 170 KL per day. So this will be the first quarter of full operations of that capacity increase. Plus, marine product business, which is into domestic and exports, was hit because of restaurants, hotels being closed because of the pandemic. So there also you've seen pickup started again and margins are improving. So that these two businesses growth in the next couple of years should be very good because of capacity expansion and because of opening up, which is happening in hotels and restaurants. And it's a debt-free company, and if you see the valuation also, it is just available at less than 7 times the FY23. So they would do close to 2,900 crores of revenue and about 75 crores of profit. And the market cap is only 511, 520 crores. So that's pretty reasonably priced with the ROC, expected ROC of more than 20-22% in the next financial year, FY23. So I would say that one can get a good 30-40% return in the stock if you're an investor for 1.5 years.
In conversation with Kunal, Nuresh and Dipin Mehta. Dipin, are you still holding on to your investment in Nazareth? And Dipin, I must say that I've got a 10-year-old kid, and the biggest challenge for me as a dad and for us as parents now is, bhai, video game kam khelo. Now, what is bad for kids today is good for Nazareth. I'm sure you use that logic. But are you still holding on to Nazareth?
Yeah, Nikunj, your assessment is right, but they also have certain applications for kids in the education space. Of course, that's not growing as fast as some of the other applications which Nazareth has got. And, we buy stocks for the long term, and Nazareth clearly is a 5-10 year type of a story. And we'd like to see all the investments which they have made to play out and the synergies to be realized. And then how the industry shapes up and how the new users come up, I think that needs to be seen. Not too concerned about the short-term performance, but all that one can say is that even in the Indian space, on the private equity side, all these gaming companies are getting higher and higher valuations. And in that respect, I think Nazareth seems to be a slightly undervalued. So if you're a player for the long haul, then at corrections, you could look at buying into Nazareth. And you need to stomach the fact that there may be volatility earnings and long periods where there may not be any profits, meaningful profits as well. But from time to time, I think if the company makes interesting acquisitions and shows that progress has been made on adding value post those acquisitions, then I think shareholders of Nazareth would be pretty much fine and the stock would continue to outperform.
There's a lot of comeback, Dipin, in a Zamato, Nykaa, Policy Bazaar.
One second, before that I want to ask, I'm sure your son is forever gaming. Aren't you gaming with him?
No, the
You
game,
also love gaming.
No, the choice of games is different. The point is that now the difference is...
So you do game with him.
Well, honest confession, it's good family time. We call it family time.
Yeah, best way to put it. And apart from that, I think we were talking about purchasing power as well. So the likes of Nykaa, Zomato, all of these also stand to benefit. I'm sure you guys are making lots of calls for ordering
No,
food
Zomato
in.
is very simple. There was a time, at least when I was your age, Avan, the dining out experience was once or twice a week. Now it's 4-5 times. As Indians now, we are savoring more cuisines. We are ordering out a lot more. So as a concept is ordering at home here to stay. I think it's only going to increase. The point is, how do you value a franchise like Zomato Dipin when they are claiming that they will give you food in 10 minutes?
Nick, it's a marketing ploy, and it's not going to be, I think, a serious service per se. You try to create excitement on the platform by such strategic marketing plans and hope that some of the other businesses, get the benefit of it. But I think companies like Zomato, Nykaa, Nazareth, Paytm, you need to have a leap of faith in these companies and hope that one of them will get the business model right and become a highly successful platform, which in 2, 3, 5 years can generate humongous amount of cash and create a great deal of value. And then such businesses are always going to be valued at premium multiples. And hopefully, if you get even 1 or 2 of these companies right, then it would take care of all the losses or the underperformance of some of the other companies. So with platform companies, you just don't know which one is going to be a winner. And perhaps the best way to play would be through a basket of such new age digital companies, or maybe even if there's a specific portfolio management scheme or a mutual fund which invests in these new age digital companies. That could also be a good investment idea. But as I said, I think these are all 3-5 year type of bets. So we are clearly designing a portfolio at the end of the current decade, that's around 2029, 2030. At that point of time, I'm pretty certain that it's one of these new age digital companies which will be among the top 10, 15 in terms of market capitalization.
They've been at 36,000 crore of market cap. Now that official obituaries have been written about Paytm, and everybody has a reason why you should not buy into Paytm, is it worth, let's say, investing 0.5% of your portfolio, 1% of your portfolio? Because while there is a question mark around the business per se and when they will be profitable, but there is a real brand and they have real data sitting on it of millions, not millions, but crores of Indians, and Paytm pretty much knows everything in terms of bank details, transaction, track record, what we do, whom we pay, whom we receive money from.
Yeah, I think it's a compelling argument, but I'd like to buy Paytm when I'm convinced about its road to profitability. And by then the stock price may have even doubled, but the risk return profile will favor you at that point of time. Right now, I think they have got their fingers in many pies. They're not a market leader in any of the segments that they are present in, maybe except for payments. And there's a lot of challenges over there. So once it gets a particular niche right, it gets a system in place to monetize its huge network and its platform. That time you can jump into the stock and the story will become more clear. Value would have got created, and at least you won't have the risk of buying a stock and it declining by 15-20%, which is likely at this point of time. So Paytm is in a kind of a unique position as compared to some of the other new age digital companies. Like Nykaa has a specific business model as to how they are going to grow the business and what the potential is. The same is true for Zomato. You can add Fino Payment Bank also to the list. You could even add Car Trade, to that particular list, where they know exactly what they're going to do and how eventually they will start to create value. But at Paytm, I think it's still a lot of shifting sands over there, and it's not clear as to which specific medium is going to yield a lot of profits for them. But they have got some fantastic assets in place, especially the kind of subscribers which they have got. It's a great brand, no doubt about it. But let's see how it actually plays out.
Since we're talking about these new age tech companies, quote unquote, here's what Vikas Khemani from Billion Capital Advisors has to say about them.
Not really. I think, if since you referenced some of my newsletters last year, we wrote in the middle of when the new tech was at peak that, we wrote a letter saying fade, FOMO fade. So this fad will fade away. People are acting out of fear of missing out. And whenever investors start doing that, out of, that psychology, we know that it's close to peak of bubble, right? And that's what has happened. According to me, many of those companies, and I said this publicly, I think one of the channels that I have done banking all my life, right? All people IPOs which went public, in that phase, probably many of them won't exist in 5 years, 10 years down the line, and many of them will erode serious value, right? So whenever this kind of frenzy is there, idea is to always stay away. And I do believe that many of the new tech companies don't even have a robust business model. So we would stay away from that. Of course, it's not that we are blind to the disruption, but we also don't want to get bought into overplaying of this disruption theme. Sometimes I feel markets have overplayed this disruption themes. Of course, you have to constantly keep watching out. Business models are evolving, and some of them are incredibly good businesses. So I'm not making that point that they're bad, but you got to be very, very mindful. As an investor, our job is to make money from a risk reward point of view, not to be part of every party and just hang around there. So we have stayed away, and I still think that there is a fraud. I still don't think that got sort of cleared big time. So we will watch out.
Okay, in the meantime, JP Morgan has actually upgraded Nalco now to an overweight from the earlier neutral stance. Talk about whether or not the metals sector has more rally to go. While clearly JP Morgan does believe so about Nalco, let me take it across to Sharad and find out what the takeaways of their latest note are.
JP Morgan has upgraded Nalco's viewing and they have made it to overweight from the neutral space. Now the target price is set at almost 158 rupees per share, and if you see, the brokerage has stated higher earnings will actually translate into higher dividend payout. They're expecting a payout ratio of almost 45% going ahead, and they did explain that their company itself is well placed in the current alumina and the aluminum environment, and of course a higher margins they can expect despite the raw material cost going up. Apart from this, they also expect that the investors should focus on the upstream stocks going ahead, and do remember 1% rise in alumina prices impacts EPS by almost 1%, and for aluminium it is a 2.5% rise in the EPS. Now the higher earnings will actually go into higher dividends, and they also expect the consensus earnings upgrades to kick in. However, key risks also include that if the aluminium prices fall below $2,500 per ton and alumina prices fall below the $300 mark.
Okay, so that's Nalco, which has got upgrades. Remember earlier we've told you about downgrades that had come in for Hindalco. Dipin Mehta, I'm going to come to you with one stock which we've discussed here on the channel. We're like, what's going on? Tata Elxsi, yesterday high by 4%, year to date high by 50%. What do you make of this?
First, the disclosure that we and our clients are invested in it, and I think this is what when you are the absolute market leader in terms of growth, and there's so much of decent earning visibility backed by the Tata brand, high corporate governance standards, then you're going to have some sort of a frenzy. And that's what we are witnessing in Tata Elxsi. I think it's what we are seeing is just frenzy taking place at this point of time. It could be that some of the portfolio managers of mutual funds which are holding Tata Elxsi, as and when they are getting more money into their schemes, they are doing a rebalancing and buying more of the same stock which they own and which has performed well for them. That perhaps is the only explanation. Also, the software being among the first of the amongst the first companies to declare results, you could see some pre-earnings buying also taking place over there, which may be short-term in nature. But at these levels, I don't think that one could look at buying into Tata Elxsi. The risk return is not favorable. Let's see what the numbers come out, and thereafter, if there's a correction, maybe 15-20% or so, and what exactly the prospects are, because there are some clouds emerging on the software side because of this particular war in Europe. So then we can reassess the prospects of Tata Elxsi and make a more informed guess as to what the returns could be going forward or so. But there's no doubt that Tata Elxsi, because of its position, because of its presence in verticals where there is massive disruption taking place, and because of its super specialization, it will be a company which will always be on the radar of many investors, and perhaps have have superior growth rates compared to the entire industry, whether you compare to mid cap or large cap.
So right now it's in, of course, frenzied demand. Naresh, I'm going to come to you for this one. If you look at the stock prices of the tire companies in the calendar year, we did see them skid earlier, right? There was talk of subdued demand, higher input costs. Yesterday there has been news, once again, source based, that the antitrust regulator CCI has been raiding certain tire companies. How would you approach the tire pack? What would be your pecking order? This, of course, I'm asking you before earnings season 2 and the revival that we're hearing in the auto sector. Naresh, that was for you.
So looking at the auto sector as such, I'm looking out for some bit of a consolidation out here totally, but a good bottom is in place for most of the names. So Maruti, a good bottom is in place at 6,500 to 6,800, 670 to 700, Mahindra and Mahindra, a good bottom is in place. Bajaj Auto, for example, is actually outperforming. Hero MotoCorp has made the bottom at 2150, retested the lows last month. So overall, waiting out for say momentum breakouts, which is where Mahindra and Mahindra is on well placed for a flag breakout as of now in the short term. In the long term, the stock is still available at the prices where it was in 2014 to 2016. So it has been an underperformer for a really long time. Eventually, I would expect this to be a big outperformer looking at the structure. So in the auto pack, like Mahindra and Mahindra is the best play.
Now, the interesting bit I want to just point out here is that let's look at the 3-month change of DMart and we'll superimpose it with Trent, Aditya Birla Fashion Retail. The interesting bit here is like DMart is just coming down. Trent is another very expensive stock which is only going higher. It's almost a life high for Trent, and almost a new low for DMart. I mean, DMart has seen almost like a 50% fall. That's Avenue Supermart for you. YTD change, please. And the YTD change on your screen, there you go, superimpose it. Just a mirror image. Dipin, why is this happening?
But it's not a mirror to mirror or apple to apple comparison. I mean, the two different businesses, they sell very different products.
I completely agree. What is the proposition of DMart? Value. What is the proposition of Trent? Zara, which is an aspirational upper middle class brand, West Side, highly affordable, and a balance sheet
but
which
still
is
not what Avenue does.
Yeah, Avenue has got it right in terms of the value proposition. My point here is that both these stocks at some point in time were commanding strong P multiples. Trent P multiple has not collapsed. It has only gone higher. DMart's P multiple, in a sense, has collapsed. And Dipin, why?
See, Nikunj, you got to account for the fact that right through the pandemic last couple of years or so, DMart's earnings have remained more or less stable and they have even perhaps improved. Whereas some of the fashion retailers like Trent, Aditya Birla, V-Mart, you're looking at trailing 12-month numbers, which are quite weak because of lockdowns. And therefore, optically, their valuations appear to be on the higher side when you compare to a DMart also. But I think that one of the best unlocked trade is the retail sector. And the likes of Trent, V-Mart, even Aditya Birla Fashion should do exceptionally well with the kind of revenge buying which we are seeing. And they have been able to raise prices as well. So perhaps margins will be protected. And I think the pandemic has certainly taught a thing or two to these retailers how to maintain their costs and improve their margins in that respect. So generally very positive on the sector, and the best stock in our opinion with usual disclosures is V-Mart, which has acquired the Unlimited brand, and that could be a value creator. Coming specifically to DMart, I wouldn't write it off. You see, right now there's a perception issue that there's intense competition in terms of delivery of groceries, and that may have a disruptive impact on DMart per se. But DMart also has its own plans in terms of online sales and quick deliveries. At the same time, the basic proposition of giving value to its customers, that remains pretty much intact. Balance sheet quality is exceptional, and maybe at these levels, valuations also have been quite attractive. And even from the present scale of operations in terms of revenue and profitability, this company can continue to compound its earnings for the next, 5, 10, 15 years or so. Because end of the day, companies like DMart are just gradually gaining market share at the expense of the unorganized Kirana sector as they give more and more value to their customers. And with adding of many more verticals and many more brands, I think that DMart will continue to be a steady performer. And it's only a matter of time before investors recognize the earnings potential, especially the compounding potential of a company like DMart, and start and the company's and the share price. So then start to at least be a market performer and eventually an outperformer.
All right, a quick look at the pre-open rates this morning, and for the Sensex, we're up by about 300 points, while the Nifty, though, is laying low, 17,453 on the index as we speak. Do remember, indications of a soft start from the SGX Nifty. The US markets as well had snapped that gaining streak. Let's reconnect with our charters, get in some mid-cap trading recommendations. Kunal Bothra as well as Naresh Mirani joining in yet again. And Kunal, let's get in a flavor as to what's standing out within the broader markets.
So yesterday, one of the stock which did pretty well for itself was Quest Corp. The stock was up some 8%. Yesterday closed at the higher point of the day. More importantly, the volumes were extremely strong for Quest Corp. The chart patterns indicate that the stock has broken out finally after above its 50 DMA after a period of almost 2.5 to 3 months for itself. So this could be a sign of a strong turn of events for Quest Corp. Hence, from a medium-term basis, would suggest a buy, positional targets of 712, stop loss 630.
And we'll be getting on board the management today as well of Quest Corp, so get in a little more detail on the fundamental side. Meantime, Naresh, let's get in your top recommendation. What stands out from the mid-cap universe?
Continuing the bullish stance on Bata India, which could break out over the 1980 mark, just around that prices for the last couple of sessions. Once it breaks out, could be a quick move to 2200, a stop loss at 1920.
Okay, that's the view coming in. Bata India it is from Naresh's stable. As well as Quest Corp, those were the two recommendations from the mid-cap universe. Meantime, Dipan, wanted to get in your thoughts as to how you're looking at the entire opening up theme as well, because we have seen a lot of sectors that had been depressed largely on account of the COVID-led pandemic, be it the multiplex sector, retail, hotels, hospitality, aviation. The entire gamut really stands to gain now. What is it that you would cherry pick within the open up trade theme or the reopen again trade theme?
We discussed retail, and that vertical is one of the top verticals in our opinion to play the unlock trade. Aviation as well as multiplex look quite interesting at this point of time, but prices have been bid up. Maybe at corrections, 10, 15, 20% type of corrections, these companies certainly look quite interesting. And they have a good runway for growth for the next 2-3 years or so, as they claw back and activity levels kind of pick up and go beyond what was there in the pre-COVID era. So those two sectors also look quite interesting to us. And by and large, I think if you look at some of the other specific businesses, like niche businesses like Delta Corp is something which comes to mind. Where, of course, disclosure that we and our clients are invested. Last 2-3 quarters have been exceptionally good. They have an online gaming gaming subsidiary as well that could be a value unlocking opportunity. And with the possibility of onshore casinos, that could be a big opportunity for a company like Delta Corp. And this particular pandemic has, in a way, reduced competitive intensity for the company. So positive on that that company as well. And there are many such nuggets, I think, in the unlock trade that one could look at in the entertainment space, which may deliver good returns over the next 2-3 quarters or so.
Smartly. Bet on habits, Dipan. Kids play video games by Nazareth. Adults like to play a different game which is called Casino. Bet on Delta Corp. What is the next one? You're betting on adults, you're betting on kids. What is that habit? What is the third habit you're betting on?
Right now, I don't have anything fresh in terms, but there are many interesting businesses. You discussed Quest Corp and Team Lease. I think these companies have had stagnant performance last 2-3 years or so, but they will really benefit from the kind of investments taking place in terms of startup ecosystem, as well as many of the other verticals, be it construction, engineering, and of course, software is also doing well. Both these companies are sitting on a lot of talent, And right now, across the entire economy, most industries are facing a talent crunch. So positive on both Quest Corp as well as Team Lease. I think the numbers which come over the next few quarters will be quite astounding. These companies are great operating leverages, and to an extent, I would say pricing power, and they would be gaining market share at the expense of the unorganized sector as well. So these are companies which one should keep in reckoning and look at good opportunities to enter them. And then there are the usual profitable platform companies which a lot of investors are, which is the favorite of many investors, the likes of IndiaMart, Affle India, Root Mobile. I think looking forward to very good numbers coming in from these companies as well. And let's see how they are scaling up their businesses and whether they are able to create even further value from these levels or so. These market correction has resulted in a lot of, I would say, P multiples are now in a way reasonable compared to what the earnings potential are. So there are many such ideas, and then there's of course software, mid-cap software, large-cap software. I think we're looking forward to a really exciting earnings season, and let's see how the numbers come through. But on the whole, as a strategy, we'd like to get into new stocks or add to existing holdings only after the company has announced its results for the March quarter. And that would give us a better idea of what the situation is and what the earnings potential is and how the management sees its business shaping up over the next fiscal year.